Good afternoon, and thank you for joining us for today's virtual alumni workshop on tax smart retirement income strategies. We'll take a brief moment to allow everyone to log in. While we wait, feel free to introduce yourself in the chat box by sharing your name, graduation year if you're an alum, and what brought you here today. Well, my name is Molly Clevin, and I'm with the University of Minnesota Duluth Alumni Relations team. In today's Alumni Career Workshop, you'll learn smart tax planning strategies designed to help you make informed and confident decisions when withdrawing from your retirement and investment accounts. Today's session is in a webinar format, and you're welcome to comment or ask questions using the chat and the Q&A buttons on the bottom of your screen. Please note that we're unable to address personal or individualized financial questions during today's session. Now it's my pleasure to introduce our guest speaker, UMD alum Vince Darling. Vince has been in the financial service industry since 2018 and became a certified financial planner professional in 2022. He graduated from UMD in 2019 and now works with the Stonebridge Group, a family business, as a financial advisor. He specializes in comprehensive financial planning, investment management, tax planning, and student loan planning. In his spare time, Vince enjoys traveling back to Duluth with his wife, Sadie, who is also a UMD alum, and spending time golfing, water skiing, mountain biking, and cheering on the Bulldogs. It is now my pleasure to hand it over to Vince.
Awesome. Awesome. Thanks, Molly. Hello, everyone. Thanks for tuning in today for this quick hour about taxes in retirement and withdrawal strategies. To let you guys know, this is probably one of my favorite topics to talk about. I think there's a lot of value that can be seen in doing these different strategies because at the end of the day, a lot of people have saved all this money up to their retirement, but then really don't want it all taken away from Uncle Sam. So, what are some strategies we can be doing today to help kind of reduce that burden? That's really what I want to cover today with you guys. As Molly mentioned, none of this is personal information. This is just strategies out there. I have no idea how it pertains to you because I don't know your situation. So I just want to make sure I say that up front because what you're going to get in this hour seminar are some techniques and some tools and some stuff out there, but I wouldn't consider it advice by any means. So jumping in here. So, being in the industry, look, a disclaimer. So, this presentation is for educational and informational purposes only. This is not considered advice. Please consult your own financial advisor, tax advisor, legal advisor, or any other professional that helps you make these decisions. Jumping into the agenda here. So, we are talking about some topics about tax strategies, beginning with the Secure Act 1.0 and 2.0 that were taking place in early 2020s. These are changes that happened to the tax code that I just want to make you guys aware of if you haven't heard already. RMDs, when I'm talking tax planning, RMDs seems to be in 9 out of 10 conversations I have with clients. And really the understanding of how different withdrawals happen from different tax buckets, your 401ks, your Roth accounts, your brokerage accounts, how does it all play out? How is everything taxed? You've worked so hard saving into these buckets. Some people didn't realize that, they're taxed differently. So I want to go over to make sure you guys understand how they're taxed in that aspect. We're going to go over QCDs, qualified charitable distributions. Another big one that tends to be on a lot of people's minds are Roth conversions. So we're going to spend a majority of the time there. We're going to talk about tax loss gain harvesting in brokerage accounts, understanding how Social Security is taxed, and then lastly, just leave you guys with an efficient asset allocation. What I think where I see big problems in people's retirement accounts, non-retirement accounts, and how these small tweaks can make changes to your tax situation. So hopping in, the biggest change in legislature happened with the Secure Act 1 and 2.0. Here are the things that I want you to get out of this. the big things, bigger catch-up contributions. So if you're between the ages of 60 and 63, you have what's called a super catch-up. It allows you to put additional dollars on top of the catch-up contributions that you're allowed after the age of 50. So just remember, you can actually put additional dollars between these years of 60 and 63. Starting this year, what a lot of people don't know about is when it comes to those catch-up contributions, higher income earners that make over 150,000, those catch-up contributions actually have to go to the Roth bucket. So if your employer doesn't offer that, it might have to be a conversation of, are you able to make any catch-ups contributions for that year? Not going to be talking too much about bullet point one there, but for two, RMDs, that's going to be talked about a lot today. RMDs, required minimum distributions, if you're not aware, maybe you're already taking them. It's pretty much money that you have to take out of your retirement account every year once you reach a certain age. Think of it this way. You were getting a tax benefit on the way in by decreasing your income. And now Uncle Sam's knocking on your door saying, hey, I let all this grow tax deferred. It's about time I get some of that money back. That's all a required minimum distribution is. So pretty much the IRS is making you take a portion of that money out to pay the taxes on it. Big changes there. They pushed the RMD age back to 73 to 75 based off your age of or birth date. Missed RMD penalty. Before, if you missed your RMD for that tax year, whatever that RMD was, let's say it was $2,000, you had to pay a 50% penalty. So $1,000 of penalty for your taxes if you didn't take it out that tax year. Looks like they got a little nicer. Instead of 50%, they changed it to 25%. Still a penalty if you forget to take it out. Hey, but if you correct it, we'll only make it a 10%. So they've made it a little easier, or a little nicer, I should say, but still, it's not like you're getting a pass to not take out these RMDs. Another big one, you used to have to take RMDs out of Roth 401ks. You no longer have to do that. That started in 2024. Another big key of the Secure Act, inherit accounts. There's a new 10-year rule. Before you could get, let's say, parents passed, you inherited an account, you were able to stretch that account over your lifetime, taking small RMDs throughout those years. Now a new rule came. This doesn't apply to spouses. Spouses still have their rules that they can do with inherited accounts. But inherited accounts for, non-spouses, they have now changed it over a 10-year period. So, if you're taking a small amount of RMDs in years 1 through 9, and you still have this big bucket of inherited money in year 10, well, you could trigger a large tax bill in that year 10. So, knowing that you have to get this thing out in 10 years, depending on the size of this IRA, you could have a tax situation on your hand. This is probably one of the biggest planning things that have come up out of Secure Act as well. All right. So, what I wanted to hop into here is just understanding the difference of the tax buckets that you've been saving into. The first, we'll start actually in the center there, the pre-tax account. Everyone's aware what this is. They probably have it through their employer. It's, your 401k. Maybe you're saving in a traditional IRA, but 401k is for most people. What is happening, as I mentioned before, is you're putting money in from your paycheck into the 401k, which reduces your taxable income for that year. You don't touch it. As long as you wait till age 59 and a half, you can take that money out without a penalty, but you have to pay the taxes on it. So you got the tax benefit on the way in. It grew tax deferred, meaning you don't pay taxes while it's sitting in that 401k, but once you take it out, you got to take the money out and pay tax on it. So what does that mean? You probably don't get a 1099 every year saying, hey, there's interest and dividends happening in that 401k account because it's tax deferred. You don't have to pay the taxes on that while it sits in that account. It's a tax advantage account. So what I want to show you is just, what does that look like on your, 1099? So what you'll see is, let's say you have a W-2 income, is when it comes to a 401k, say you make 50,000 a year and you put in 5,000. Instead of 50,000 showing up in this line 1A, it would show 45,000 because you put it in your 401k, reducing your taxable income. If we're taking distributions out of your 401k, that's when we see, I'll just do an IRA here. So let's say you're taking out a traditional IRA, you'll see a distribution amount, and that's what you see here in yellow. Hey, we took money out of our IRA, which is taxable. It gets added to this line on your 1040. Okay, going back. Next bucket is your Roth bucket. Becoming more and more popular as people know more about Roths. Roth IRA, Roth 401k. This account, much different than the pre-tax account. Pretty much what's happening is you're taking after-tax money. When I mean after-tax, just means, hey, if you make $50,000 and you put 5,000 into a Roth, on this first line here, 1A, it's still going to show 50,000. It's not going to show 45,000 like it did on the pre-tax side. So you're putting money in there. It's growing tax-free or tax-deferred as well, meaning you're not paying interest and dividends in there. It doesn't matter if you buy and sell. Capital gains and losses means nothing. Pretty much you just have to satisfy two rules. Hey, you held it for 5 years and you're 59 and a half. Once that, you can take out what's called qualified withdrawals, which you can take all the income out tax-free. Okay? So those are the two there. The third is a taxable brokerage account. This is not a tax advantaged account. This is just saying, hey, you have some extra savings that you're not keeping in your checking and savings account. You're investing it. You're investing it in mutual funds, stocks, bonds, ETFs, whatever it may be. But it's a brokerage account that you're investing with, but it's not tax advantaged by any means. So what does that mean? You're paying taxes on interest and dividends every year. If you buy or if you sell things at a capital gain, you realize a capital gain. If you sell things at a loss, it's capital loss. So what does that look like here? I highlighted it in blue. Hey, the dividends coming out of that account will show up here in 3B. Capital gain. If you're selling things at a capital gain or a position made money and you sold it, you're realizing it on your capital gain here in line 7 here. So hopefully this kind of clears it up, these three buckets that I'll be talking about today. But I just think it's really important that you understand that there's three buckets that you're pulling out of if you've saved in all of them. Some of you might only have money in pre-tax account. Some of you might only have Roth money. Some maybe only brokerage account money. Maybe you have all three. I just want to go over to make sure you understand the three different kinds here. Okay, hopping into RMDs, we talked a little bit about it today already, but as we mentioned, you used to have to take money out of those pre-tax retirement accounts, like I mentioned on the last slide, at 70 and a half. They were generous enough to now change that to 73 and 75. The second line here, you're probably already taking RMDs at this point. So really, we're delaying this pretty much to age 75 for people born January 1st, 1960 or later. Okay? So what does that mean? It means, hey, pros, delay taxable income. You don't have to get forced to take those required minimum distributions out at 70 and a half. You can delay it to 75 based off your date of birth, of course. Reduce taxation on Social Security benefits. We're going to hop into talking about that, how Social Security is taxed, because it's based off what other income you have that determines how much of your Social Security is taxable. So hey, we could reduce some taxation of Social Security for some years. This gives you possibly more time to do strategic planning like we're talking about today. Roth conversions, timing of those withdrawals, maybe taking distributions from those IRAs in those early years. Um, the cons, potential for larger RMDs later. What does that mean? The account continues to grow tax deferred. If markets are doing well and you didn't take any money out from age 70 and a half to 75, you're going to have a bigger balance. And when that's thrown in the, uniform lifetime table that they throw it in to determine your RMD amount, a higher number normally means a higher RMD. Risk of delaying too long because you don't have to withdraw yet. Um, if you don't have to do it, why think about it? So people don't plan in these early years, and then all of a sudden they have this RMD that they have to take out. And the years that they should have been taking a small amount or a certain amount, maybe they didn't. Out of sight, out of mind. Uh, and I just want to reiterate it again. This is pre-tax money. This is money from a 401k, traditional IRA. We're not talking about brokerage accounts. We're not talking about Roth amounts or Roth accounts as well. All right. So I know I'm trying to get a lot of information in a small amount of time here. But next, we're going to talk about how Social Security is taxed. I get this question all the time when people start going through their financial plan, is going over the taxability of Social Security. There was this big thing in the big beautiful bill that was recently passed that mentioned, hey, there's no more taxes on Social Security. That is, I would say, more of a political saying more than anything. Social Security is still taxable. What did happen though is you got an extra standard deduction on your 1040 if you're over the age of, I believe it's 65. So what does that mean? I'll show you on 1040 here. Here's that standard deduction. If you take a standard deduction, for a married couple, instead of, in this case, whatever it may be, it might already be added in here. But this number that deducted from um, your other income is higher based off whatever your income is. So what I'm trying to tell you is it's not that your Social Security isn't taxed anymore. It's that there's possible that your standard deduction is higher, making less of your income taxable. Okay. But jumping into how it's taxed, uh, it really comes down to your other income. So based off these charts here, what it kind of looks like is, hey, if all your other income, and when I mean other income, I mean up here, all your other income outside of Social Security is between these amounts, 50% of your Social Security is taxable. If it's higher than 34,000, 85% is taxable. If it's below these, none of it's taxable. And you can see here for the married filing jointly as well. So I just want you guys to know that because this goes into the planning process as well of when we're talking about when to take certain amounts out. So I just showed you an example here. Um, so we can see your taxable amount, 11,548, even though you made, in this person's case, 13,000 of Social Security benefits, only 1150 or 11,000 was taxable. And that's because only 85% in this person's case was taxable, not the full 100%, not the full 13,000. Okay? So hopefully that sheds a little bit more light of how Social Security is taxed when you start thinking about your situation. So why is this important? Why am I telling you all this and talking about Social Security possibly delaying? Because when you delay Social Security, you may not only be, earning more because you've delayed, they give you a higher benefit, but it might create additional room for withdrawal strategies out of your pre-tax accounts. And when I talk about this, I mean Roth conversions. Because this is what the planning process really goes through is that dreaded RMD tax time balloon. This is one of those things that I run into a lot of people that have large pre-tax accounts, meaning, they did all the right things. They're saving all that money. It's done well in the market, but now they have to pay Uncle Sam. And they realize that their account that they've been saving into is not worth as much as they think, because a lot of that would go to taxes. And by people not planning properly, a lot of that extra money can go towards um, taxes, which no one really wants that to happen. So I got a chart here. It kind of shows this example from our planning software that kind of shows this exact thing happening in this person's situation. Okay, this is all hypothetical, but you can see, hey, this person decided to retire at 63. For many of their income years between 63 and 75, you can see they're between the 10 and 12% tax bracket. They really haven't, really low income. Maybe they have that taxable money that they're taking out of from their brokerage account, but really their income's really low. And then you can see in year 70, when they turn 75, that their income jumps. It jumped from the 10 to 12% bracket to now the 22, 24, and you can actually see it reach in their 80s, 32%. We just moved money that was being taxed at 12% to 32%. That's 20% extra taxes on money just because of RMDs. Okay? This is that tax time balloon. This is what people run into situations that they didn't really think about in these low income years. Okay? That's where Roth conversions can come in. And it doesn't even have to be a Roth conversion. Maybe it's you actually just taking the money out of the account. But in this case, we're going to talk about Roth conversions. Comes up in conversations all the time. What is it? What is it? We're moving money from a pre-tax IRA or 401k into a Roth IRA. We're taking pre-tax money, paying the taxes, converting it to a Roth where it can grow, um, tax-free in the future. Converted amount is taxable in the year of conversion. People don't realize that. Yes. What are you giving up? You're giving up that tax deferred growth because you're paying the taxes on it right now. Future growth and qualified withdrawals are tax free. I mean, if you satisfy in that Roth account the 5 years and 59 and a half, they can grow tax free in that Roth account. So, what's the point of it? Why do people do it? First, reduce future RMDs. Why does it do that? If we're moving money from this big bucket, putting some over here, making this bucket smaller, the calculation in the RMD is going to make the RMD smaller. Okay? We can create tax-free income in retirement, meaning, hey, we're moving money to a Roth that we could draw from in later years, possibly reducing some of that, your income to show up on your tax return. Um, Better tax outcome for heirs. This is even more important because of that 10-year rule. What if your sons and daughters are making, a good income and they're in a higher tax bracket, and then all of a sudden something happens to you guys, and they inherit this large pre-tax account. They're going to run into their own tax situation trying to unwind this thing in those 10 years. Before it wasn't as much of an issue because they could uh, um, stretch it out over their lifetime. That's not the case anymore. And then, of course, hedge against higher future tax rates, meaning exactly what I showed you in that last slide. We're trying to avoid you going into those higher tax breaks and trying to pay in those lower tax brackets. Okay. Trade-offs. Uh, Financial planning is all about trade-offs. I like to tell that to everyone. So what are you trading off? You're paying taxes now. That money that you're paying in taxes, is no longer growing in your account. So you're giving away some of that tax deferral. You can increase your AGI affecting Medicare IRMA, and many of you might have already heard of that. And that's pretty much based off your income. Your Medicare premiums could go up. Oh no, if healthcare wasn't expensive already. Requires available cash to pay. So what I mean by that is, hey, you got to pay the tax on this. Do you have the income to pay for that? Because if you keep taking it out of a pre-tax account, you're just making it even a higher withdrawal. So best timing that we tend to see this, if at all. I have some clients that we don't even do Roth conversions because it doesn't even make sense for them. But low income years, normally that's in your early retirement. Before RMDs begin, before you get into that situation where you're forced to take money out of it. And during market downturns. Sometimes we can take money, if your account drops 20% because of the market, maybe it's time to take that money out, move it into a tax-free zone, and hopefully when the market comes back, hey, we just got some tax-free growth. It's one of those strategies as well for the timing of it. Um, so here's an example that I took from our planning software and kind of made a hypothetical as well. So in this case, this person has a lot of pre-tax IRA money and 401k money. So what we're looking at here, I want you guys to look at the blue line here. So that blue line, or blue graph, I should say, you can see that, hey, they're in a pretty low tax rate. But then once they hit 75, you can see it going from that, they were sitting in the 10 to 12. Now they're shooting up to the 22 and over the 24 by the time they're in their mid 80s. Okay. So we're adding an additional, 12% tax, on this person's situation. So what if we decide to do Roth conversions? That's this green bar here. If we did large Roth conversions early before we hit the RMD age. And this is what we're showing is we see that graph doesn't shoot up anymore because we've moved a lot of that money into Roth accounts. So in this certain strategy here. It says, hey, we're you know, possibly having about 4 million more in tax adjusted ending assets based off this strategy. But really what I go over with clients is, hey, if we do this strategy, hey, we're paying taxes now, but look, by doing this over your lifetime, we might save around this much in taxes by doing this now because we're taking it out at lower tax rates versus higher in the future. Okay. This isn't the case for everyone. I've run these same scenarios with others, and this is actually, they end up paying more. And it didn't make sense to do it at all. This is what I mean. It really depends on your situation if Roth conversions make sense. Okay. But this can be a huge strategy. I mean, in this case, 835,000 of less taxes paid that you can use for yourself, go to your heirs. Uh, that's what proper planning can do. And when you have a proper Roth conversion strategy. But of course, with every good strategy, there's things you have to look out for. And I brought it up, Medicare IRMA. This is what we go over with a lot of clients when we're talking about these strategies because, hey, when your income reaches certain levels, your Part B premium for Medicare and Part D go up. A lot of people don't think about that and maybe do these large Roth conversions in 1 year, all of a sudden shooting their IRMA limits, you know, up to very high amounts for that 1 year. And they don't know why. They got a letter in the mail saying, hey, your Medicare premium is going up for the year. And they didn't even think about this when doing their Roth conversions. Keep IRMA in mind because it's not only your tax brackets that we're looking at, but we might look at these type of brackets too. Okay? But keep that in mind if you're looking at your own Roth conversion strategy. All right. Um, Going into qualified, how am I doing on time? About 30, 27 minutes in, so we're doing just fine. So getting into qualified charitable distributions. This is a strategy that a lot of clients of ours use to get money to charities that they really want to, help give towards, and do it in a tax efficient way. So, what is a qualified charitable distribution? It's a direct donation from an IRA, not a 401k. I see that mistake, or people bring that up. You cannot do a qualified charitable distribution from a 401k to a qualified charity. And normally that qualified charity has to be a 501c3 type of charity. And what we're doing is we're taking money from that pre-tax IRA, excluding it from taxable income, even though you're taking a distribution, it's not taxable and can satisfy some of your RMD or all of it. So that way it doesn't show up on your tax return. So who can do this? You have to be at least 70 and a half. People have asked me with them changing the RMD age that, hey, I can't do this till 75. No, your RMD age changed, not your charitable distribution, qualified charitable distribution age. That is still 70 and a half. It can be taken from a traditional or inherited IRA. And I think I just looked at it. The 2026 numbers is 111,000 per person. Has to be a 501c3 charity. You cannot put it in a donor advised fund or private foundations. Why do people do this? Reduce their taxable income and still give their do their charity that they're maybe taking it out of their own pocket currently when it might make sense to take it out of their IRA instead. If, depending on your income, it could reduce your Social Security, possibly your Medicare IRMA if you're right on one of the cusp of one of those limits. Often better than writing a check directly to that charity. So what do you have to keep? You have to keep a receipt acknowledgement of your donation, your Form 1099-R of your IRA that shows, hey, I made a charitable distribution. They're fixing it this year. They used to not list them on the 1099-R, and you had to let your tax person know. But it should be for most custodians. They are putting it on there now. Proof of direct IRA to charity transfer, meaning, hey, they want to make sure it went from your IRA to the charitable organization, not going to you first and then the charitable organization. Okay. I have people ask me questions on that all the time. Well, can I just take a distribution and then give it to the charity? No, it has to go directly to the charity. So bringing up another grade 1040, kind of show you what this looks like. Let's say this person, decided to take 33,755 out of their IRA. Okay. And let's say they decided, hey, I'm going to give three of this, I'm just giving to charity. Well, if they did three of that and gave it to charity, um, they wouldn't get a qualified charitable distribution. And this is saying this person's over 70 and a half. So in this case, let's say we do a 3,000. They want to do that same example and give that 3,000 to the charity. So what does that look like? And we'll look at that total tax at the bottom there. So you can see it change in yellow from 33 to 30 because now we're doing a qualified charitable distribution. And we can see the total tax on line 24 at the bottom without the qualified charitable distribution. In this case, this person owes $930 in taxes. They did a 3,000 charitable distribution, qualified charitable distribution. Now it's only 616. So just saving a little bit in taxes by doing that strategy there. Okay. Remember, you got to satisfy everything. Make sure it's considered a qualified charitable distribution, else you're not going to get that tax benefit. Okay. All right. Jumping into non-retirement accounts. This is that taxable brokerage account we talked about on like slide 3. This is that not tax advantage account. But what are some things you can be doing in there to maybe help with your taxes along the way as well? Strategy out there that people can do, tax loss and tax gain harvesting. Um, what that means is, hey, you have money that you're making in the account or not making in the account. Maybe you pick some poor investments and it's actually gone down. But you're buying and selling things to initially realize losses and gains in your taxable account. This is not your 401k. This is not your Roth. This is only for brokerage accounts. I want to make that clear. So losses offset gains dollar for dollar, and you can actually take an additional 3,000 of losses can offset ordinary income. Unused losses carry forward for future years. Meaning if you generate, 30,000 in losses, you can only realize 3,000 for that tax year. 27,000 can be used for other years. Maybe when you have gains in your account or you have an investment property that you sell, anything like that. Gain harvesting means realizing gains when capital gains taxes are low, possibly zero. I'm going to jump into those rates next. You often utilize this in low income years or maybe early retirement when your income's low. I'll say it again. Only in taxable brokerage accounts. Okay. Uh, a big rule that people often miss when doing this strategy is the wash sale rule, meaning you can't repurchase substantially identical securities within 30 days. Here's an example. Let's say you purchase stock ABC for $1,000. It drops 50%. Now it's only worth $500. You then sell it. You realize that $5,000 of losses, okay? And then the next day you repurchase that same ABC stock. IRS doesn't like that. That's, they know what you're trying to do. They know you're just trying to realize that loss and get back into what you were already in. They do not allow you to do that. You have to give it at least 30 days before you even think about going back into that position, or else you trigger a wash sale rule where you can't realize that loss. Okay. Use losses to reduce taxes and use gains when taxes are favorable. This is things that you can be doing in this account. Okay. So, as I mentioned, we've talked a lot about ordinary income tax rates. That's kind of that 12, 22, 24, 32, 37. Those are ordinary income tax rates. Capital gains are taxed at a different tax rate. Those are long-term capital gains rates or short-term capital gains rates. Okay. Short-term capital gains rates is if you held that position for less than a year, you're taxed as ordinary income. Same as that 12, 22, 24 that I showed you earlier. Okay. If you hold it for more than a year, you get and you decide to sell it, you have long-term capital gains rates. Uh, so in this example, this is just the from the IRS, the capital gains, long-term capital gains rates. So this is what I mean. Like if your income's in, below 49,000, you can trigger some of those gains at 0%. Okay. 15% between these. And if your income's over this, it's up to 20%. But these are ways that you can trigger some of those gains to keep you at these low capital gains rates. Okay. Um, what often is missed is they never trigger gains. And then you have these large gains that no one wants to sell because they know they're going to trigger taxes. So that's why it does make sense. Look at it every year, see if it makes sense to trigger any of those gains. And especially during market downfalls, if there's any losses you can trigger, not only for the current tax year, but years you can use that in the future. Okay. So here's an example, exactly what I'm talking about. So let's say you buy stock ABC for $10,000. That stock drops to $7,000. And you say, you know what, I don't really want stock ABC anymore. I'm going to accept my losses, $3,000 capital loss. How is that loss used? Let's say for this particular tax year, you have no other capital gains for this year. Okay. So you can offset your ordinary income with that $3,000. And I show that here. This is your income. This is that $3,000 loss, that capital gain and loss. You can show up to 3,000 on your tax statement. So we can reduce your income by triggering that loss. Okay? If it's higher than this, let's say it's more than 3,000, let's say it's 5,000, you can still only trigger 3,000 of losses that offset ordinary income, and then other 2,000 is a carry forward loss for future tax years. Okay? Lastly, how are we doing on time? 12:37. Perfect. So this is what I'm going to end with here. Things that you can be working on in these accounts is just what you're investing in within these three types of buckets. I see this wrong all the time. And sometimes it's just you can't make the change for them. But I just want to share this with you, things that you guys could maybe be looking at in your own accounts. So we're going to go and start with the Roth IRA accounts here. So when I'm looking at efficient asset allocation, I'm looking at things that we can do that are efficient taxable, or maybe for your heirs moving down the road, or when you pull it out. So for instance, we just talked about if you satisfy the requirements for a Roth, you can take money out tax free. Okay. So in my opinion, we can take money, we want that bucket to grow. Anything that grows in there is tax free if we satisfy the requirements. So when I'm looking at investing in a Roth, I'm looking at those high growth equities, maybe some small caps, some international, things with higher standard deviations that we can utilize to try to grow that Roth account over time. Of course, if you're pulling from your Roth IRA in years, in the next couple of years, you might not want to be taking that much risk with certain investments because we know investments can go up and down. But if you have years that you're not touching that Roth, why don't we try to make it grow as much as possible? Because now we can take out of that money tax free if we satisfy the requirements. Okay. So when I see things in here in a Roth, they have bonds in their Roth, things that don't grow that much historically. I ask them, I'm like, hey, are you utilizing this Roth in the next couple of years? And normally I get the answer no. And I just don't quite understand it. So that's what I look at when I'm looking at efficient asset allocation in Roths. So traditional IRA, 401ks, and your pre-tax moving up a line here, we want those things more income producing, maybe your high dividend, because if it's income producing, high dividend, we don't have to pay taxes on it when it's sent out into the account because it's tax deferred. It's only when you take a withdrawal from the pre-tax accounts that you're taxed. Okay. So we can reinvest those things and not have to worry about the taxes. So that's why I want to look into putting those type of investments in there. Um, this is what I also tend to see. I see accounts, let's say you're not 100% equity. A lot of people aren't. They're not willing to take that much risk, especially if they're 3 to 4 years out from retirement. Okay. And I see, hey, there's 60% equity and 40% fixed income. Makes sense. You don't want to be taking that amount of risk at 100%, so you're reducing your risk. But what I get frustrated at is, they have a 60/40 portfolio in the pre-tax and a 60/40 portfolio in the Roth. It's identical. That is not efficient. What is efficient is maybe you still want to, with your whole bucket of money, your pre-tax and your Roth money, you still want to be 60/40 because you don't want to take on that risk. Map it in a way that probably for that 40% bonds is probably sitting in your traditional IRA or your 401k, where your Roth has more of those high flyers, those growth type of companies. But overall, within your whole bucket of money, we're still sitting 60/40, but we're dividing it properly and efficiently between the two types of accounts. Okay. Lastly, the taxable account. This is that not no, not tax advantage. So what do we not want in there? Things that produce a lot of income, things that produce a lot of dividends. Those things get kicked out every year, and then you have to pay the taxes on it every year, and can lead to higher taxes for you. Another thing, I see a lot of mutual funds in um, in taxable accounts. Mutual funds kick out a normally a higher capital gains rate than most ETFs. Not all, there's some that still do, but that kick out higher capital gains um, that you can't avoid. You just have to accept it on your tax return. Doesn't matter if you make it a withdrawal or not, and that can be quite annoying on a tax return. Okay. And I understand, because we have to worry about selling things in a taxable account that maybe you're sitting on a lot of gains on that investment that you just can't sell it. So I want to reiterate that you can't make all these changes super quickly like you could in a pre-tax or a Roth account or an IRA account, because taxable accounts you can trigger capital gains, so you have to be wary of that. I want to make that very important because after today, I don't want people making all these changes and then realizing all these capital gains. So you got to be weary about that. Okay. But if you're starting a brokerage account, try to avoid those mutual funds to begin with. Maybe if you're in higher tax brackets, you look into municipal bonds. Municipal bonds are a way you don't have to pay um, federal tax on the income. So people invest in municipals to try to keep their income down in those taxable accounts. Because even though it's triggering income, it's not taxable at the federal level. Okay. I ran into a case about a month ago, municipal bonds in a Roth IRA. I couldn't figure it out. And I couldn't get any answers about it as well. So munis play a great part in taxable accounts. Um, So your main goal in the taxable account, try to do those tax loss gains and harvesting of your capital gains. Try to reduce dividends that are kicked out. Try to reduce capital gains that are kicked out. Munis, if they make sense based off your tax situation. What we don't want to do is do tons of different trading in taxable accounts, triggering extra taxes. So you have to be really efficient in taxable accounts uh, of what you purchase. Okay. So this is what I think of efficient asset allocation. I see when I look at thousands of statements through the course of the year, I don't always see it properly managed. And sometimes it's with other advisors, sometimes it's someone doing it themselves. It's just these are things that you can be doing and looking at and seeing if it makes sense.